Good morning, friends. Today we are going to discuss something about the financial derivatives. What is the purpose of understanding these particular financial derivatives in the modern world? What are the advantages of this particular financial derivatives? What are the varieties of the financial derivatives we have? Before we understand something about the financial derivatives, we need to understand something about the risk. What is a risk actually? In simple terms, risk can be defined as a likelihood of losses or unexpected outcomes arising from an exposure. It is a likelihood of losses or unexpected outcomes arising from an exposure. That is the reason why we are interested in studying about these particular financial derivatives. Whenever we are transacting something, whenever we are indulging in buying anything, obviously the transaction will attract either the benefit or either the loss. The asset prices actually in general may come up or come down. But as a student of finance, we like to see that we don't get losses or we minimize the losses. And that is reason actually we enter into various kinds of derivatives. And before understanding the financial derivatives, we also need to understand something about what kind of risks usually we face in day-to-day life. For an organization, the organization may face either a strategic risk or it may face a financial risk or it may have operational risk or it may have some compliance risk apart from the many. Though each of these particular risks are going to adversely affect, the most dangerous of all this particular risk is the financial risk, because it will create havoc in the organization and it may lose its existence also when we are not able to contain this particular financial risk. Definitely we all know that the world is risky. Starting from 1971, if you see, there is a collapse of Bretton Woods because exchange rates becomes flexible and volatile. In 1993, there is oil price risk shocks, and in 1987, we have Black Monday. In 1989, we have Japanese stock market deflated. In 1994, Fed increased rates 6 times consecutively, and it led to the bond market debacle. We all know about 1997 Asian crisis. Everybody started devaluing their currencies. There had been banking crisis all over Asia. In 2001, we had dot-com bubble, wherein the internet companies crashed. In 2007, there is a financial crisis across Europe, and in 1919, 2019, we are facing this particular COVID. If you see the markets, actually, the markets have become more volatile after the COVID. And this is not the end of it. We are going to face various crises, one after the other, and every individual and every organization need to understand how these crises are going to affect them and how to contain them, how to address them actually. What is this particular financial risk I'm talking about? Financial risk refers to the risk of bankruptcy arising from the failure to pay the committed amounts in time to various stakeholders of the company. The financial risk in simple is the state where the organization faces increased exposures, diminution in revenues, and losses in the value of assets in an adverse manner due to the changes in the internal and external financial environment, bringing the heightened strain. ఎందుకు అది ఏదో వచ్చేప్పుడు ఇక్కడ రికార్డ్ చేస్తున్నారు బుద్ధి లేదా? What is this particular financial risk I'm talking about? The financial risk refers to the risk of bankruptcy arising from the failure to commit the committed amounts in time to the various stakeholders of the company. The financial risk is very, very dangerous. The organizations are going to collapse within no time. It will not give any time to address this particular issue, and within no time, the organization collapses. So we have to be very, very careful with this particular financial risk. What are the reasons for this particular financial risk? The financial risk may be due to the changes in the commodity prices, impacting the input costs or the output costs, output prices, impacting current or the future profits of the firm. The financial risk also may occur due to the changes in the bond prices, impacting the firm's loan book, oblique investments, and debt funds, negatively or positively impacting current or future profits of the firm. The financial risk may also be due to the changes in the exchange rates, impacting the foreign exchange exposure of the firm. It may be positive, it may be negative. The financial risk also may be due to the various transactions that the firm is involved in with the vendors of the firm. The financial risk also may be due to the indirect relationship with the counterparties in the derivative transactions. Apart from this, the failure to take an action or inaction on the people or the process and the physical evidence may also lead to the financial risk. So in modern days, the financial risk is very common and cannot be avoided. Then what? What should we do? There are two methods of doing it. One is get insurance. Get insured. One can manage the risk by transferring it to another party who is willing to assume the risk. Usually, an insurance company takes upon itself some risks on behalf of a client. But usually you will find that all the risks cannot be transferred, particularly in bond risks and other investment risks. We cannot transfer those particular risks, and usually the insurance companies are not going to take that kind of risks. What is the other way around? One can create financial hedges against our financial assets and physical assets. And there comes the world of derivatives or derivative strategies. Then you may like to ask me, what are these particular derivatives? In simple, a derivative is a financial instrument that derives its value from an underlying security. The underlying security may be a stock or a stock index, a bond price, or an interest rate. It may be a foreign exchange. It may be a commodity price. So, a derivative is an instrument on an underlying asset. A derivative, in simple, is a side bet on interest rates, exchange rates, commodity prices, and practically anything that you can think of. So it is also an instrument. It's a financial instrument which has a value, which will give a value in the crisis. So what are the varieties of these particular derivatives? When did these particular derivatives evolve? The Dojima rice market in district of Osaka can be considered as the first futures market in the sense of an organized exchange. The modern futures market in Western Hemisphere was born in the Chicago CBOT in 1848. In 1877, LME was founded and is now the leading exchange. The first financial futures market was the International Monetary Market, founded in 1972 by CME, followed by LIFFE in 1982. While options are of much recent origin, they were the first traded in CBOT on April 26, 1973. The introduction of traded options opened the way for the evolution of modern complex derivatives. In India, on June 12, 2000, we have seen the birth of Nifty futures, and by June 4, 2001, Nifty options were introduced and traded, while in July 2nd, 2001, we have futures on individual securities, and by the year end, we have various options on individual securities. In India, we have cross-currency derivatives. We have cross-currency derivatives in INR. We have INR interest rate derivatives. And we are now having all the varieties of derivatives relating to the interests, relating to the currencies, relating to the commodities, relating to the stocks, if not everything. So these are the varieties of derivatives we are having. So there are basically exchange traded products, OTC traded products. But OTC products are not very much of interest to many, and the transactions in OTC markets are not there at all in India. We are finding more of exchange traded derivatives nowadays. We have equity derivatives, we have debt derivatives, we have forex derivatives, we have commodity derivatives. In equities, we have index futures, we have stock futures, we have options, single stock options, index options. In debt, we have interest rate futures. In forex, we have currency futures. In commodities, we are having commodity futures. So what are these particular varieties of futures contracts, and what are the forwards? What is the difference between forward and a future? A forward contract is an agreement to buy or sell an asset at a price determined now, but is settled later at a predetermined date. Futures also resembles the same, but futures is a standardized forward contract that is traded on an exchange. Standardization may relate to the size of the contract, delivery of the contract obligation, quotations of the price, the specification of the underlying asset. That is, if you are talking about gold, they specify the quality of the gold, the size of the contract. Is it going to be 10 grams gold, which you can trade with what quality, when, and within? What is the standard with regard to the period in which you have to deliver? Delivery, that is called delivery obligation. So usually each and every exchange comes out with standards with regard to the size of the contract, delivery obligations, quotations. That is, I'm talking about tick prices, which we are going to discuss later, and also the underlying specifications with regard to the underlying asset. Underlying asset may be gold, a chana dal, or a rice, or it can be a stock, it can be an interest, or anything actually. So the exchanges are going to fix the various standards. On the basis of that, we can go in for a derivative contract. Other kind of derivative is the option. What is this particular options? What are these particular options? An option contract is a derivative instrument wherein it provides the holder with a right to buy or sell a specified quantity of an underlying asset at a fixed price on or before the expiration date of the option. Since it is a right, the option holder will not be having the obligation to exercise his option. He can allow the option to expire. That is the advantage when compared to the forward or the futures contract. Let me give you an example to make you understand clearly what is the difference between an option contract and a futures contract or a forward contract. If you are buying something in futures or a forward contract, you have an obligation to pay for the underlying asset, pay for that particular stock or the commodity or the currency, and pay that particular amount on that particular expiry date. But in the case if you are buying the stock through an option contract, we will not be obligated to take up those stocks if the price is not favorable to us. Let me give an example through a small example, live example. Why we wanted to buy these particular options? If you are very much sure of that the price is going to go up because of the various reasons, every individual has his own thinking and mechanisms to understand the forward prices, either through the fundamental analysis or the technical analysis. If I am sure that the prices are going to go up, I might be interested in buying the stock, a particular stock, say Reliance stock, by paying cash or by paying going for a forward contract wherein I will be not be obligated to pay the whole amount, but pay the small margin and wait until the expiration. Of course, mark to mark margins you have to pay it, which I am going to talk when I am going to speak in the other video about the futures contract. We have an option. We have the time to take the delivery by paying only the margin amount. Wait up to that particular last date. Pick up that particular stock. But you have an obligation to take that particular thing. Even though the transaction is not favorable or not favorable, you have the obligation to take those stocks. At the time of buying, you paid, say, you entered a contract wherein the spot price is 2000 and the futures price is 2002 rupees. On the expiration date, it is 1990 rupees. You cannot avoid it. You have to pick it up at that particular higher price only because you are obligated to do that because of the contract. But if the price goes up, you are going to pay only 2002 rupees, but you might get 2020 rupees, and that difference you are going to pocket it as a profit. But there is a right and there is an obligation. But in the case of an options contract, you have only right, but you don't have the obligation. So if the transaction or the agreement is not favorable to you, you will allow that particular options to expire. For example, on the date of expiry, the Reliance share price is only 1990. Your strike price exercise price is 2000 rupees. You paid some premium for that. You will only lose that particular premium. You are not going to lose anything. You will allow that particular contract to expire. Only thing is you will be losing that particular premium. But if the price goes up to 2100, you paid a premium of 7 rupees to get that particular contract. You will definitely exercise that particular option wherein the other fellow has to give the stocks at 2100 and 2100 my exercise price is 2000. For each share value I'm going to get 100 rupees, of course minus the premium. So 93 rupees is going to be my profit in the event the price goes up beyond my exercise price. So that is the advantage with regard to the options. There are basically two varieties of options. One is called call option, other one is called put option. A call option gives the right to buy, whereas the put option gives the right to sell. Sometimes I feel that the market is going to fall down. I sell the index. I am going to buy a put option. I I'm going to buy put option of a Reliance stock, assuming that they assuming that the results of that particular company might not be good, which are shortly going to be announced. Then I'll be interested in buying a put option. If the prices doesn't come up but goes up, I will not be having an option. I don't need to exercise that particular option. I need not sell the stock. So that is an advantage of this particular options contract. But only disadvantage is that you are going to lose whole of that particular premium. That is the disadvantage. But why we actually enter this particular options will elaborately discuss in some other video, wherein I'm going to discuss much about this particular options. Then we have the fourth variety of the derivative is swap. What is a swap? Swap is nothing but an exchange. In simple, a swap transaction can be defined as an exchange of future cash flows between two parties as agreed upon according to the terms of the contract. There can be currency swaps, interest swaps, commodity swaps. There can be anything actually. Here usually one thing one need to understand is the underlying principle is not going to be exchanged. Only the difference in terms of the interest or the difference in terms of the actual agreed currency rate versus the currency rate on that particular date is going to be exchanged between two different parties. We'll be discussing much more about the swap transactions in the video relating to the swap, because there are different kinds of swaps. We need to actually dig into each and every kind of swap to understand much more in detail with regard to swaps. Thank you for patient hearing. I'll be coming out with detailed videos on the forwards, the futures, and options, and the option strategies and the swaps. Thank you.